2 years ago, I sat down with a gentleman I'll call Gerald. Gerald was 71 years old, a retired mechanical engineer with 38 years of deliberate, consistent saving behind him. He had followed every piece of guidance his financial professionals had ever given him, maximized his retirement contributions annually, funded his IRA without interruption, and spread his assets across several different account categories. The retirement nest egg he had built was the kind most working Americans spend their entire lives hoping for. Gerald came into my office because he had recently received correspondence from the IRS. He placed the envelope on my desk. I read through it carefully, then I read it a second time. The IRS was informing Gerald that he was responsible for more than $61,000 in assessed penalties and unpaid taxes, not because he had committed fraud, not because he had concealed assets, not because of a single dishonest act, because he had failed to withdraw funds from 4 specific accounts according to a government-mandated schedule. Money he had accumulated through completely legal means. Money he had every right to allow to continue compounding. Money that the federal government does not actually want sitting untouched. Because the moment you reach age 73, Washington has a mandatory framework dictating exactly when those dollars must begin coming out. And if you miss that framework, even by a single calendar year, the consequences are steep, automatic, and entirely preventable, provided you had simply been aware the requirement existed. Gerald had never heard of it. His financial advisor had never brought it up, his tax preparer had never flagged it, and the IRS certainly did not reach out with a courteous heads up before the deadline passed. They delivered the penalty invoice after the fact. Over $61,000, taken from a man who had spent nearly 4 decades doing absolutely everything correctly. Here is what I need you to fully absorb right now. If you are nearing age 73, or if someone you care deeply about is, there are 5 distinct account categories that carry federally mandated withdrawal obligations that the vast majority of Americans have never had explained to them in straightforward language. Fail to meet those obligations, and the IRS does not alert you in advance. It does not offer you a grace window. It levies a penalty currently set at 25% of the amount you were required to withdraw, 25% applied automatically to money you set aside through entirely lawful means. In this video, I am going to walk you through all 5 account types, precisely when the obligations activate, and the concrete steps you need to take before your 73rd birthday to make absolutely certain you never find yourself in Gerald's position. Before I take you through the 5 accounts individually, I want to give you the broader context, because this is not some minor technical footnote buried in the tax code. This is a structural issue that strips American retirees of billions of dollars in completely preventable penalties every single year. Here is the foundational rule that governs everything we are about to discuss. When Congress originally created tax-advantaged retirement savings vehicles, your 401k, your traditional IRA, your SEP IRA, a specific arrangement was built into the framework. You contribute money before it is taxed. You watch it accumulate without paying taxes on the gains. But at a defined point in time, the government expects to collect what it has been deferring. It is not prepared to wait indefinitely. That defined point carries a formal name, the required minimum distribution, commonly referred to as the RMD. And beginning at age 73, under the framework currently established by the Secure 2.0 Act, the IRS mandates that you begin pulling a minimum amount from designated accounts on an annual basis. The withdrawal amount is determined by your account balance combined with an IRS life expectancy calculation table. Skip the withdrawal and the penalty is automatic, no exceptions, no advance notice. Now here is precisely what makes this situation so treacherous for so many people. On the surface, the rule appears straightforward. Start withdrawing after you turn 73. But in practice, it is anything but simple. Different account types operate under different RMD frameworks. Some accounts require withdrawals beginning at 73. Others have entirely separate timelines. Some are excluded from RMDs under specific qualifying conditions. Some require withdrawals even if you remain employed. Others do not. And the penalty calculation, 25% of the amount you were obligated to withdraw, accumulates across every account you missed for every year you missed it. Gerald held 5 different account categories. Each carried a slightly different set of rules. He was in compliance on 2 of them. He was non-compliant on 3. 3 accounts worth of missed required distributions across 2 years, with a 25% penalty applied to each. That is precisely how a man who did everything correctly for nearly 4 decades ends up with a $61,000 bill sitting on my desk. This is not an isolated situation. The IRS processes thousands of RMD penalty assessments annually, and the overwhelming majority affect individuals who simply were not informed of the complete rules as they applied across every account category they held. After this video, you will have that information. If you want financial and legal updates that protect your assets at the moment they are most relevant, subscribe right now. This channel exists to ensure that the rules capable of costing people like Gerald tens of thousands of dollars never arrive as a shock to the people who are paying attention. Now let us go through the 5 accounts. Account number 1, the traditional IRA. I am beginning here because this is the account most people believe they already understand, and simultaneously the one where the most consequential misunderstandings tend to take root. A traditional individual retirement account is funded using pre-tax dollars. Your contributions reduced your taxable income during the years you made them. The balance grew on a tax-deferred basis. And now that you are approaching 73, the IRS intends to begin recovering the taxes it has been postponing throughout that entire period. The required minimum distribution from a traditional IRA must be initiated no later than April 1st of the calendar year that follows the year in which you turn 73. This deadline has a formal designation, your required beginning date. Here is the specific trap that catches people during year 1. Because the IRS technically allows you until April 1st of the subsequent year to take your first RMD, many individuals interpret this to mean they have no obligation to think about it until they are already 74. That interpretation is partially accurate and entirely dangerous. Here is the reason. If you wait until April 1st of the year after you turn 73 to take that first distribution, you are required to take 2 separate RMDs within that same calendar year. The first distribution covering the prior year is due by April 1st. The second distribution covering the current year is due by December 31st. 2 complete RMDs within a single calendar year means 2 full distribution amounts added to your taxable income simultaneously, which can push you into a meaningfully higher tax bracket than you had planned for. It can also trigger premium surcharges on your Medicare Part B and Part D coverage through the mechanism known as IRMAA, the income-related monthly adjustment amount. The more strategically sound approach for most individuals is to take that first RMD in the actual calendar year they turn 73, rather than delaying until April 1st of the following year. Yes, you sacrifice a few additional months of tax deferral, but you sidestep the double distribution year entirely, along with the bracket complications and Medicare surcharge exposure that tend to accompany it. Gerald delayed. He waited until April of the year he reached 74 before taking his first IRA withdrawal. He pulled that initial distribution on schedule, but then overlooked the second one, the current year RMD due by December 31st. He missed it completely. One missed required distribution, a 25% penalty assessed on the missed amount. That was his first error. Account number 2, the 401k from a previous employer. This is the account that tends to generate the most genuine surprise, because most people think of their 401k as something tied to a particular job. Once they left that position, the account became just another balance sitting somewhere in the background, automatic, passive, not demanding any active management decisions. That assumption is precisely incorrect, and it is precisely the assumption responsible for generating the highest volume of missed required distributions. Here's the governing rule. If you hold a 401k from a prior employer, a company you departed 5 years ago, 10 years ago, 20 years ago, that account is subject to RMDs beginning at 73, regardless of your current employment status and regardless of what other retirement accounts you may be actively managing. The critical distinction is between a 401k from a previous employer and a 401k held at your current employer. If you are still actively working at 73 and participating in a 401k through that current employer, a provision known as the still working exception permits you to delay required distributions from that specific plan until you actually separate from that employment. But that exception is exclusively applicable to your current employer's plan. Every retirement plan from every prior employer remains subject to the standard RMD rules beginning at 73. This is where people create serious complications for themselves. They are 73, still working part-time, and they correctly understand that the still working exception eliminates their immediate obligation for their current employer's plan. Then they extend that same conclusion, incorrectly, to the 401k sitting idle from the company they left in 2014. 2 different accounts, 2 different rules, 1 missed required distribution, a 25% penalty. Before you reach 73, track down every 401k account you have ever held through a prior employer. Every single one. Individuals with careers spanning multiple organizations sometimes hold 3, 4, or even more separate plans. Each carries its own RMD calculation. Each has its own annual deadline. Consolidating them into a single IRA rollover prior to age 73, a strategy worth exploring in conversation with a qualified financial advisor, can dramatically simplify the required distribution calculation and significantly reduce the likelihood of overlooking one. Account number 3, the SEPIRA and Simple IRA. These 2 account categories are addressed together because they operate under the same RMD framework as the traditional IRA, but they are held by an entirely different segment of the population, and the misunderstanding surrounding them takes a different form. SEPIRAs, Simplified Employee Pension, IRAs, and Simple IRAs, Savings Incentive Match Plans for Employees, are retirement accounts used primarily by self-employed individuals and small business operators. If any portion of your professional life was spent as a freelancer, independent contractor, small business owner, or self-employed professional, there is a meaningful probability that you hold one of these accounts. And here lies the problem. People who maintained these accounts during their working years frequently did not mentally categorize them the same way they categorized an employer-sponsored 401k. The SEPIRA in particular was sometimes used as an intermittent savings tool, contributions deposited during strong revenue years, nothing added during slower periods. It felt less like a formal retirement structure and more like a flexible financial reserve. That informal mental association does not alter the IRS's very formal position on the matter. A SEPIRA and a simple IRA are governed by the exact same RMD requirements as a traditional IRA. IRA, beginning at 73, calculated against the December 31st account balance of the prior year using the IRS Uniform Lifetime Table, and required to be distributed by December 31st of each subsequent year following the required beginning date. Missing the required distribution on a SEP IRA because you had mentally deprioritized it, or because you did not recognize that it carried identical rules to your standard IRA, results in the same 25% penalty as any other missed required distribution. Here is your action step. Before you reach 73, compile a thorough inventory of every retirement account you have ever held, not only the ones currently at the forefront of your financial awareness, every single one. If you were self-employed at any point, even in a secondary capacity, as a consultant, as a side business operator, as a freelance professional, verify whether a SEP IRA or simple IRA was ever established under your name. Contact the financial institution where it would have been maintained. If you are uncertain, locate it before the IRS identifies the missed distribution for you. Account number 4, the inherited IRA. This is the account category carrying the greatest degree of complexity, the most recently revised rule set, and consequently, the most widespread current confusion among individuals who are genuinely attempting to remain compliant. If you have received an IRA through inheritance from a parent, a spouse, or any other individual, the regulations governing that account are fundamentally different from the regulations governing your own IRA. And those regulations shifted substantially with the original Secure Act, then shifted again with Secure 2.0, creating a situation in which people operating on their previous understanding are now working from outdated information. Here is the current framework, explained in plain language. If you inherited an IRA from a spouse, you generally have the broadest range of options available to you. You may treat the inherited account as your own, roll it into your existing IRA, and apply standard RMD rules according to your own age, beginning at 73. If you inherited an IRA from someone other than a spouse and qualify under the IRS classification of eligible designated beneficiary, a category that includes minor children of the deceased, individuals with disabilities, chronically ill individuals, and individuals no more than 10 years younger than the original account owner, you have specific distribution options that permit you to extend withdrawals across your own life expectancy. If you inherited an IRA from someone other than a spouse and do not qualify under the eligible designated beneficiary classification, you are subject to what is known as the 10-year rule. The complete account balance must be fully distributed within 10 calendar years of the original owner's passing. And under IRS guidance issued in 2022 and formally finalized in 2024, if the original account owner had already initiated required minimum distributions prior to their death, you are obligated to take annual distributions during years 1 through 9. You cannot simply allow the balance to sit untouched and withdraw everything in year 10. This 10-year rule with mandatory annual distribution requirements is the provision currently generating the most confusion and the most penalty assessments among individuals who inherited IRAs after 2020 and did not receive accurate, updated counsel. If you hold an inherited IRA, consult a tax professional who is thoroughly current on the Post-Secure 2.0 regulatory framework before your next distribution deadline arrives. The rules are highly specific, the penalties are very real, and the regulatory guidance has evolved substantially enough over the past 3 years that advice you received previously may no longer reflect current requirements. Account number 5, the 403B account. The final account on this list is one that a very specific and very large population holds and has frequently stopped thinking about entirely. Teachers, nurses, hospital administrators, university faculty, nonprofit professionals, government employees. If your career unfolded in any of these sectors, there is a meaningful probability that you hold a 403(b) account, the tax-advantaged retirement vehicle available to employees of public school systems, nonprofit organizations, and certain government entities. And there is an equally meaningful probability that you have not given that 403(b) serious thought in years. Perhaps not since you retired. Perhaps not since you transitioned to a different position. Perhaps not since you rolled a portion of it over, but not all of it. Here is the rule. 403(b) accounts are subject to required minimum distributions beginning at age 73, operating under the same general framework as 401(k) accounts. The same required beginning date provisions apply. The same 25% penalty for missed distributions applies. And critically, the same still working exception applies for your current employer's plan, with the identical limitation that it is exclusively applicable to your current employer's plan. If you hold a 403(b) from a previous employer in education, healthcare, or nonprofit work, that account is subject to required minimum distributions beginning at 73, regardless of whether you are still working somewhere else in any capacity. The specific risk with 403(b) accounts is that they are frequently maintained at institutions, school district benefits offices, hospital system, HR departments, university retirement program administrators that do not possess the same proactive communication infrastructure as major national financial institutions. Your Fidelity or Vanguard IRA will very likely generate notices informing you of RMD obligations. Your former school district's 403(b) plan administrator may generate nothing of the kind. Do not wait for the institution to prompt you. Take full ownership of this. Locate every 403(b) account you have ever held. Calculate the required distribution. Withdraw the minimum amount before December 31st of the year you reach 73. Let me bring all 5 accounts together one final time for clarity. Your traditional IRA required minimum distributions begin at 73. Take your first distribution in the actual year you turn 73 to avoid the double distribution trap. Your 401(k) accounts from prior employers, subject to required distributions at 73, independent of your current employment status. Locate every prior employer plan immediately. Your SEPIRA or simple IRA, governed by identical rules as the traditional IRA. Track down every account established during self-employed years before the IRS identifies any missed distribution. Your inherited IRA, the governing rules changed materially under Secure 2.0. Obtain current professional guidance specific to your beneficiary classification without delay. Your 403(b) from prior employment in education, healthcare, or nonprofit sectors, subject to the complete RMD framework at 73. Do not place your reliance on the holding institution to notify you. 5 account types, every one of them carrying mandatory withdrawal obligations, every one of them backed by a 25% penalty for noncompliance, every one of them currently generating avoidable financial harm for responsible savers who simply were not told the complete picture. Gerald eventually found his way through it. His legal representative successfully negotiated a partial penalty abatement based on reasonable cause, specifically the documented failure of his financial advisor to provide adequate guidance. He was not relieved of the entire liability, but a meaningful portion was reduced. Before he left my office for the final time, he said something I have not forgotten. I dedicated 38 years to making sure I followed every rule. I just needed someone to show me what following the rules looked like once I turned 73. You now have that picture. Share this video with everyone in your life who is approaching 73 or who has already passed that point and may be missing required distributions right now without the slightest awareness that anything is wrong, because the IRS penalty clock does not pause while people wait to learn the rules. It continues running in silence until the bill appears in the mailbox. What happens if you have already missed a required distribution and are now staring at an IRS penalty notice? Watch the next video where I walk through the penalty abatement process step by step, including the specific arguments that have successfully reduced or eliminated RMD penalties for individuals who responded quickly once they discovered the problem. I will see you there.